I'm Michael Fox, and this is the Prospector News Podcast. And I am joined by a longtime friend and contributor, David Erfle of the Junior Mining Junky. How are you doing, David?
Good, Michael. How are you?
I am doing well. Let's get right into this. We're recording this after Groundhog's Day, which was last Friday. The rat saw his shadow or didn't see his shadow, so it means spring's around the corner, which where I live. That I laugh because the groundhog said that, and Mother Nature said, "Hold my beer," and gave us a 3-day blizzard. So I've been digging out since then, but. I kind of look at the gold market very similar to this Groundhog Day. And if you go back to the Bill Murray movie, where it's everything just repeats and repeats and repeats and repeats until it doesn't. Are we actually getting to that point where the gold market is actually going to stop repeating and have a breakout here?
Well, that's a great question. That's the $64 billion question, right? The gold price continues to do really well. It's consolidating above $2,000 an ounce. It's had three strong monthly closes above that level. But at the same time, ever since the end of the year, you've had both the silver and the miners continue to show relative weakness. And that has pretty much been the story over the past 3 years during this huge consolidation of the doubling of the gold price from 1045 to 2090 into mid-2020. The gold price has gone sideways, inflation's gone up, so, the all-in sustaining costs continue to go higher while the gold price maintains its price right around $2,000 an ounce, and the stock market continues to go higher. So, as far as your Groundhog Day, metaphor, I would say that, basically the groundhog is the pivot, right? The Fed pivot, the thing that, the thing that the market is waiting for, the what the market is expecting, what gold is expecting. Um, six rate cuts were on the table, now it's down to 3. The Fed continues to jawbone and say that they're gonna continue to keep interest rates, at this level. But at the same time, it was interesting to see what happened with the commercial real estate market as Powell was speaking in his press conference after the Fed kept interest rates for, I think it was a third or fourth consecutive meeting at 5.25 to 5.5%. Um, right before he started to speak, one of the largest regional banks, the New York Community Bank Corp, they announced a 70% cut to their dividend, and they posted a quarterly loss of 260 million, as opposed to what the market expected was a $250 million gain. So this is, and this is goes back to, the Fed basically understanding that this debt-based US economy, which now, by the way, takes $2.50 of debt to create $1 of GDP, is dependent on easy money. The Fed can't control government's fiscal mismanagement. Powell came on 60 Minutes over the weekend and basically said, "Hey, this path that we're on is unsustainable." Right? I mean, his quote was, "The U.S. federal government's on an unsustainable fiscal path, and that just means that the debt is growing faster than the economy, so it's unsustainable." Yes, I mean that is very unsustainable. And but then he ended up by saying, "I don't think that's at all controversial." Well, the commercial real estate market is saying something other than that. As far as the debt is concerned, it's completely out of control. Over 34 trillion now. The budget deficit is $2 trillion in debt. It takes over it's over $1 trillion of of interest rate payments alone on this debt that's continues to go up exponentially. So, this is going to break at some point, and that's what the Fed does, right? The Fed is basically reactive and not proactive. They have been ever since this gold bull market started in 2020, when Alan Greenspan came out in 2021 I mean in 2001, and that was right after the dot com bubble burst, and started off 2021 on the first day of trading with an emergency rate cut, and that began the gold bull market from 2021, the double bottom at 250, 275 area to run to 19 over $1,900 10 years later. So this is what the Fed does, right? They were also reactive in starting to raise the interest rates, right? They came out in that magic word of transitory. They kept using it, that this is transitory, inflation's going to come down, it's not going to be a problem. So instead of being proactive and raising rates when they should have, they had to be reactive and start raising too late. And now this is causing a problem where, the leading economic indicators are screaming there's going to be a recession. We just don't know when it's going to start. You never do. So the gold price is just waiting, right? It's waiting for all this to and all of a sudden also in the backdrop, you've got the US funding these endless wars now in the Middle East and Ukraine, over $100 billion being funneled. So that's the most inflationary aspect of what's happening is increasing war fears. War is super inflationary. I mean, it was the Vietnam War that got us into the problems in the 70s, right? I mean, government, financing a war they couldn't afford and having to raise interest rates to 20%. So, we could handle it back then because the debt to GDP was only 35%, and the debt and the national debt was less than a trillion. So, I know I've gone off on a diatribe here, but as far as the gold price is concerned, it's just waiting to see how all this pans out in a super controversial election year where probably neither side is going to accept the result.
That was a good diatribe actually, because one of the things that I've noticed with the gold price is it's been in a box. It was in a box most of last year, and then it kind of broke out of the box a little bit into December. It still looks like it's in the box, but we moved the box up a shelf.
Yeah,
Is that
well,
a good
it gets
way to
it,
view
it
this?
is it is that is a very good way to put it, and it gets inside this box right around key round numbers. The box was 425 to $500 when I first got into this sector in the early 2000s. That was the line of resistance that gold could not get past. But once it did, once we had a monthly close above 500, it took off and doubled over the next couple years. And it did the same. That box was and that box at 500 was about 12 to 13 years. And then the box at $1,000 was at $1,000 an ounce for only a little over a year. It ran up to 1,000, and it meandered around 1,000 for a while, and it was very volatile. It got down to less than 700 there right in 2008, when everybody was selling everything they could get their hands on to buy dollars. And then once the Federal Reserve did, guess what? They what they did was they had to have an emergency meeting and basically recapitalize the entire banking system and cut rates down to zero. And that was what was the catalyst to double the gold price again to almost $2,000 an ounce. It got to 1,900 back in 2011, and then basically we had to consolidate that move of 250 to 1,900 over the next several years, and it got down to 1,000, a 50% correction, almost 1,000, and then it doubled again to 2,000, and now that box, as you pointed out, is almost 4 years in the making at around 2,000, right? From 1675 to around 2,000, 2,100, and that Maginot line now of bankster resistance is at $2,100. I mean, it's bumped up there a couple times, and now it's $2,100 where we need a technical monthly close above that level for a technical breakout. And the powers that be are doing everything they can to hold it down below that level. Central banks are continuing to buy, yet Western investors still don't see the big picture, and they're continuing to stay away from gold and just buy U.S. equities. So until we start to see some fear in the stock market, start to get defensive, the gold price is probably going to be held up by central bank buying, but it's not going to break out. And a key thing to watch to where the gold price may be about to break out is if you start to see silver and the mining sector begin to show relative strength and start to lead, because both silver, if you take a look at the charts of both silver and the mining sector, they look almost exactly the same over the past 4 years during this consolidation, and they're consolidating into this huge symmetrical triangle to where they're about to make a move, either a breakout or a breakdown out of that triangle. I expect it might be a breakdown. And it'll be a false move because that's what the gold market loves to do, right? It loves to have these false moves before there's a major breakout. It happened it happened in 2008, where you had the false move below $1,000, where it got down to 620, I think it was 680 or something like that. And then we had the big huge move. So the false move creates the energy for the big move, for the big breakout, and that's what we need. So I wouldn't be surprised if the gold price gets down to that 1980 2000 support level. That wouldn't shock me. It might even get down to 1950, but that would be a false move, because we had the same thing happen at 1675. 1675 was strong support for a really long for a few years, and every all the market pundits, all the sector pundits, and all the bears were saying, okay, if that 1675 level breaks, you're going to see 1500, 1450 gold again. Well, it got down to 1620, and it was a bear trap false move. And what happened? The gold price ran up $475 over the next several months. So this is what we could see here, is a false move before the big move. So we could see a fake out before the breakout, in essence.
Yeah, yeah, when you watch gold, it has a tendency to do that, and that kind of segues, and you sort of kind of answered it, was when I was referring to the gold being in the box. We talked about the ceiling on the box, but we didn't really discuss the floor. And the question I was going to have is 2000 the new floor, barring a breakdown, a false breakdown. So are you suggesting that yeah, it is, but the false breakdown could go below that? Did
It
I
could,
understand that
yes.
right?
Once the market starts to price in a a gold floor at 2000, and I mean that by when you start to see the miners start to outperform, on a relative basis, start to outperform the gold price along with the silver price. That'll be a hint that the market's starting to price in that $2,000 floor. We're not there yet. Even though we've had 3 solid monthly closes above that level, we haven't had a monthly close above 2,100, because 2089 was the high back in 2020. And technically, if you get once you get a monthly close above 2,100, that would complete the handle on the nearly 4-year handle on the massive 13-year cup and handle pattern on the gold price. You take a step back, take a look at the gold price. It's doing fine. It's doing really fine when you take a look at what's happening with the dollar, what's happening with the stock market. I mean, if you take a look at the dollar index, it's starting to go higher from testing that 100 level, which was really which is really key support, and the gold price really hasn't done much, even though the USDX has gone up 4 clicks to hit resistance at 104 this week. It's still hanging around 2050, and it's still consolidating that huge move that it had when we had that intraday overnight spike to 2150. That was overnight, and didn't happen during the COMEX. We didn't get a close above 2100. We didn't get a close above 2090, which is where it reached back in mid 2020. So that that consolidation is still happening, and there's so many catalysts lurking out there that could pop it higher, but I'd much rather see it be a macroeconomic catalyst than a geopolitical catalyst, because what you got going on in the Middle East now with tit for tat attacks between Iran-backed rebels and the United States, that's a powder keg waiting to happen. And you really don't want to see the gold price move up, and sharply on geopolitical reasons, because they usually come back. That the price usually comes down, and it usually signifies that it could be a short-term top if it's a huge spike on geopolitical concerns. I'm not saying it would be, but there's a possibility that it could. I mean, if you take a look back at the 70s, the gold price went from $100 to $400 from 1975 to late 1979. And in December 1979, it doubled again. It went from 400 to $800 in the matter of about 8 weeks, because Russia rolled into Afghanistan, and that was basically the catalyst for the parabolic top in the gold price at around 850, and then it corrected for 20 years thereafter. So, I know that basically the financial system is in much more dire straits now. So we've got a lot more catalysts to keep the gold price higher this time. But all I'm saying is I'd rather the catalyst be macroeconomic as opposed to geopolitical when it does break out.
Yeah, no, definitely. There's a lot of things out there that could cause gold to move on the upside on an economic level rather than a geopolitical level. So, I agree with you. If there's a geopolitical event, it's likely just to cause a bull fake, and they're gonna, gold will spike briefly for a period of time and then settle back to the mean. But um, there is an elephant in the room, and and it's located in China. There's a very large real estate company called Evergrande, as you're aware, that's essentially being forced into liquidation and bankruptcy. And the debts of Evergrande are considerably more than what the debts of Lehman Brothers was in the 2008 crisis. So does that have the potential to cause a gold breakout without the fake out?
Well, absolutely, but I think that the U.S. real estate, commercial real estate price crisis would be a stronger catalyst if some banks failed because of that. Because you even had Janet Yellen come out today and say that she's concerned about that. You've had the IMF write a paper that expressing their concern about the commercial real estate market. I mean, there's trillions of dollars that need to be refinanced at higher rates. And the bottom line is that the U.S. economy cannot keep chugging along the way it's been chugging along with these with these higher interest rates. Because I mean, another stories came out. Another Fed report came out today saying credit card delinquencies are 50% higher. Were 50% higher in 2023 and swelled to 17.5 trillion. So, consumers can continue to borrow just as much as the US government to keep this economy going. And that's unsustainable, which is what Powell, referred to in his 60 Minutes interview. I mean, this is unsustainable. And there's going to be an event where the Federal Reserve will have to see. Basically, Michael, what's going to happen, I think, is the Fed is not going to pivot until they're forced to. They're going to keep this up as long as they can, keep these interest rates as high as they can until something forces them to call an emergency meeting and do a 25 basis point or 50 basis point rate cut, just like they did in 2001. And as far as where the bubble is now, it's obviously in these magnificent seven AI stocks, right? These seven stocks that are basically 70% of the S&P's growth over the past year or so. So that's the big bubble waiting to pop. And when it does, and when the stock market starts to come down, and it is an election year, and the Fed is basically democratically left leaning. So they're going to have to. I think they're going to have to pivot. They're going to be forced to pivot by exogenous event, an outside catalyst, on an outside catalyst. I don't think they're going to do it willingly. Um, so they're going to just keep pushing it off. They're not going to. They're not going to lower. They're not going to pivot in March unless they're forced to, and they're probably not going to pivot during the next meeting in May unless they're forced to. So, gold is sniffing all this out, but like I said, the miners in silver are not showing that the gold price is creating a $2,000 floor just yet. Just watch the silver price and the miners. Watch them in relation to the gold price. When they start to outperform, especially if they start to outperform strongly, then that's going to give you a hint that hey, the gold price is about to take off, and this $2,000 floor is about to be priced in by the market.
Yeah, that was going to be my next question. What are we going to see a catalyst under silver? The same fundamentals that are driving gold should be driving the silver market. And we talk about gold being stagnant in a box. Well, so silver's the box is smaller, and you know it's
Yeah, I
not
mean,
only on a
if you take
shelf. We
the
can't even figure out what shelf it's on.
Oh, yeah, absolutely. If you take the inflation, if just CPI inflation, which is hedonically adjusted, if you take the CPI inflation adjusted rate of silver from its high in 1980 at $50 an ounce, silver should be $150 an ounce, as far as inflation adjusted, and the gold price should only be $3,000 an ounce. So silver has a lot of catching up to do, as do the miners, right? The gold stocks have never been this cheap in relation to the price of gold, while at the same time miners' balance sheets have never been this healthy while paying a dividend. When I got into this sector 20 years ago, it was unheard of for a mining stock to pay a dividend. Now they're paying dividends and they have super strong, healthy balance sheets. I mean, Newmont alone, after the Newcrest merger, has 3.2 billion in cash.
Yeah, and there's probably some projects that they're going to sell off
Yeah,
that they're not
right.
looking.
They've already
So
said they're
that's
going to sell some Australian assets. Right.
yeah. So yeah, the miners themselves are in good financial stead, except for their share price. And as someone that takes a look at that, I just it defies logic in a lot of ways. But
Well,
if
it
I
does in some ways, but in other ways, it makes perfect sense.
yeah.
Because the stock market continues to go higher. There's just no impetus for investors to take a risk in those risky gold stocks, right? When everything else just continues to go higher, and we could just continue to just buy the S&P, buy the Dow, buy the Nasdaq, and make money, and put our money in and put our savings in some treasury bills, which is also making money at 5%. So there's no reason for them to even mess around with gold stocks, even though they've got the best multiples I've ever seen since I've been in this sector for 20 years. I mean, they're like I said, their balance sheets are the healthiest they've ever been. And as far as the juniors are concerned, they're just ridiculously cheap because these miners are going to have to start replacing their ounces. So we're going to see some M&A. We're going to see some more strategic some strategic placements in these majors into some juniors, because these juniors, there's first of all, there's far too many of them. A lot of them have to go away. Not all of them are going to get financed, but the best ones are, and the best ones continue to get financed, and the best ones are starting to bifurcate. You're starting to see that over the past week or so.
Yeah, I was at the VRIC in Vancouver about a week ago, and you know, as languishing as the share prices are for these companies, I wasn't walking through the floor and seeing a lot of moose pasture companies.
Yeah, they can't afford it. They can't
the
afford to come to these conferences, right? They're doing everything they can to keep the lights on.
Well, and the reality is that there's some excellent deals out there, and I liken to the advice I got back in university. Only schmucks buy retail; everyone else buys wholesale. So I kind of look at it that way, and it's definitely a full opportunity.
It is, but
I
it's a stock picker's market. You have to grab the right ones to hold for the long term.
Definitely. Now, I've been asking all the analysts that I've had on here since the first of the year to make a comment and then a prediction. And the question I've been asking everybody is, what was the biggest surprise outside of the war in the Middle East, because that blindsided everybody. But what was the biggest surprise for you in 2023? And where do you see things running off in 2024?
I think the biggest surprise was to see the stock market continue higher as opposed to double topping. That's what I was expecting it to happen. I was expecting, okay, we're gonna see a double top, and then we're gonna see the stock market go down into 2024 because of so many surprises that are lurking out there that could really hit investors in 2024, that the market's gonna start to see this and it's gonna go lower. It hasn't, it's gone higher, and as a result, the mining stocks continue to trade sideways or go lower. All that does, as far as I'm concerned, though, is it creates an incredible opportunity to accumulate the right companies, because the right companies, that are de-risking high margin projects that are controlled by very sharp management teams that have done this before, and they know when to raise money, and they have the access to capital, and they got strong institutional ownership. Um, it's a great time to continue to accumulate these stocks, because quality junior minor babies are being thrown out with the lifestyle junior bathwater continually. And I only hope that when the finance window does open, that it doesn't open for these moose pasture juniors as well. Because then we're going to have the same thing happen all over again, where everything starts to go up, and and the companies that shouldn't go up, they pretty much need to go away, because they need to realize that, hey, your company's never going to get bought out by a major. And then you could say that about 80 to 85% of these companies. But I know that I'm probably digressing away from the second part of my answer. What was the second part of your question?
The second part of the question is, what do you project out for 2024? We've talked about the fake out before the breakout, but is there anything that you see on the horizon that's, going to be pivotal to what happens economically in 2024?
Well, I just think the presidential election is going to create massive volatility in the stock market, because you've got both sides doing whatever they can to discredit the other. I mean, there is no I just don't see one side accepting the other side's win. That's been happening since 2016 when Trump won. It's been not my president from both sides. Hillary basically said that Trump stole the election with Russian interference, and then Trump said that Biden stole the election with U.S. interference, with mail-in voting, ballot voting. So, I just see that the both sides getting farther and farther apart, creating, unfortunately, civil unrest, creating a lot of volatility in the stock market. I mean, with what's going on, I mean, there's a possibility that neither Biden nor Trump could be the candidate. I mean, it could be even as crazy as that. So that's
Well, I don't
gonna
think
create a
that's
lot of
crazy.
uncertainty.
I'm in the minority. It's actually projecting that.
Yeah, I mean, that's gonna create a lot of uncertainty, and gold loves uncertainty. I mean, the last 2 presidential elections, years, gold has done really, really well. 2016, the gold price did really well. In 2020, the gold price did really well. So, and we're building up to a point where the gold price is about to break out. So the gold stocks and silver are saying gold's gonna break down. Yet all the fundamentals that's happening out there, there's so many catalysts out there that say the gold price is gonna break out. So if it does break out, that means that both silver and the miners have a lot of catching up to do. So if you accumulate the right companies in an environment like this, you'll do very, very well in 2024.
Yeah, as you were going through that description of everything, I just had this imaginary moment where Marjorie Taylor Greene and AOC were sitting around a campfire singing Kumbaya and eating s'mores. I'm guessing that is really not going to happen in this election year. If people want to follow your work and see what you're picking, how would they do so, David?
Yeah, you could find me on Kitco. I read a sometimes weekly article. I skip a week here and there on kitco.com every Friday. And also my website is junior minor junky with a y.com. You could follow my work there, my interviews and my editorials. All of them are posted on that website.
Wonderful. I look forward to having you back on in another month's time as we see how everything progresses forward. And you take care of yourself.
You too, Michael. Thanks a lot.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.